It is August on a ski mountain, and almost everything a customer comes here to buy does not exist yet. There is no groomed snow, no powder, no packed trail. The lifts may be quiet, snowcats can be parked. Maintenance crews are repairing equipment instead of moving skiers. The mountain is consuming money before it has a winter product to sell. And yet, somewhere far from the empty slopes, customers are already paying for next season. That is the strange part of this business. A ski resort can carry expensive machinery, buildings, payroll, permits, insurance, maintenance, and capital projects through an entire year, while the heart of the winter business may be concentrated into something that looks, from the outside, like roughly 4 months. 4 months is not a universal rule. Some mountains run longer, some shorter, and conditions change every year. But the underlying owner problem is the same. Enormous fixed costs meet a selling season that depends on weather. So if we were operating this mountain, the question would not simply be, how expensive can we make the lift ticket? The question would be, can this mountain produce enough reliable cash economics to justify all the capital trapped inside it? And the modern answer begins before the first snowflake falls. To understand the economics, we need one real mountain instead of an imaginary national average, so we will use Bridger Bowl in Montana as our operating anchor. Not because Bridger represents every ski resort. It does not. Bridger is a non-profit ski area, which makes it a very different ownership model from a public company like Vail Resorts. But Bridger publishes unusually useful operating and financial information, which lets us see the machinery of a single mountain more clearly. Even the land is more complicated than the phrase "owns a ski resort" suggests. Forest Service planning documents describe Bridger's base operations as being on private property, while its ski terrain extends onto land in the Custer-Gallatin National Forest. So the ski area is not automatically the same thing as owning the mountain, owning the nearby town, owning every hotel, or collecting every dollar a visitor spends on the trip. That distinction will matter later. For its 2025-2026 budget methodology, Bridger used 320,000 annual skier visits as its operating anchor, and a skier visit is not a unique customer. If one person skis 10 different days, that is 10 skier visits. The previous season gives us a sense of the physical intensity behind that number. Bridger reported 121 operating days, roughly 364,000 skier visits, and 578 employees. That is our first clue that this is not just a chairlift business. A mountain with a little more than 100 operating days can require hundreds of people and millions of dollars of physical infrastructure. Now we can ask what each of those visits is actually worth. A customer sees a posted day ticket price and naturally starts multiplying. For the 2026-2027 season, Bridger lists a full-day adult ticket at $86 online and $99 at the window. At Vail Mountain, the visible price can be dramatically higher. Vail's own investor materials have shown example window pricing above $300 for a day, depending on the date. That creates an easy story. Hundreds of thousands of visits, multiplied by a very expensive ticket, must equal an extraordinary business. But that calculation is wrong before it begins. Because most skier visits are not necessarily paying the highest posted ticket price. People come through season passes, advance products, multi-day tickets, promotional products, and other access categories. Bridger makes this visible. Its fall 2025 materials reported revenue per skier visit of $71.31. That is total revenue per visit in its budget framework, not a $99 window ticket multiplied by every skier on the mountain. Its reported revenue mix was also revealing. About 46% season passes, 31% day tickets, and 8% food and beverage, with the rest coming from other categories. And Bridger's current full adult season pass is priced at roughly $1,100 starting in August, rising later in the selling cycle. So imagine a local who skis 20 days on that pass. The theoretical window value of those 20 days could be almost $2,000 at Bridger's current window price. The resort deliberately sells access for much less. Why would an owner do that? Because the customer is giving the resort something in return, not just money, commitment. A day ticket customer can wait. They can wake up, look at the forecast, check the snow report, check the roads, look at their schedule, and decide whether the mountain is worth visiting. That means the customer keeps most of the weather risk until the last possible moment. A season pass customer makes a very different trade. They commit before they know how many powder days will arrive, how warm January will be, or how often they personally will be able to ski. The resort gives up some potential revenue per visit. In exchange, it gets a customer who has already made a decision. At Vail Resorts, this model has become central to the business. In fiscal 2025, pass products accounted for roughly 65% of lift revenue. For the 2025-2026 season, Vail said about 2.3 million guests had committed in advance across 42 resorts using advance commitment products. The company expected those products to generate approximately $1 billion of revenue and account for roughly 74% of skier visits, excluding complimentary visits. That is an enormous amount of winter demand that was not waiting to see whether December would be snowy. At the industry level, the same direction is visible. In its preliminary May 2026 figures, the National Ski Areas Association said season passes represented 49% of visits at responding U.S. ski areas, while daily and multi-day tickets represented 31%. This is why a cheap-looking season pass can make economic sense. The resort is not simply discounting skiing, it is buying predictability from the customer. But there is an accounting trap here, because money collected early is not the same thing as revenue already earned. Suppose we sell a season pass in September. The customer pays us in September. Our bank account may receive cash in September, but we have not yet delivered an entire winter of skiing in September. Vail's filings make this distinction explicit. Pass products are predominantly sold, and cash is primarily collected before the ski season. Accounting revenue is then recognized through the ski season as the service is delivered. So when someone says a ski company makes nearly $1 billion before winter, we have to ask exactly what that number means. For Vail's 2025-2026 season, the company said its advance commitment products were expected to generate approximately $1 billion of revenue. That does not mean $1 billion was already recognized as revenue before the lifts opened. And it is not the same number as deferred revenue on the balance sheet. At January 31, 2026, Vail reported about $717 million of short-term deferred revenue. Within that, deferred revenue specifically related to North American pass product sales was about $503 million. Cash received, deferred revenue, and recognized revenue are connected. They are not interchangeable. Now that we have separated them, we can test the real business question. Does advance commitment actually protect the mountain when winter goes badly? The 2025-2026 season gave Vail Resorts an unusually useful real-world stress test. Through April 19, 2026, skier visits at Vail's North American resorts were down 14.9% from the comparable period a year earlier. Lift revenue, including allocated pass revenue, was down only 5.6%. That gap is the business model in action. Visits fell much more sharply than lift revenue. But the protection stopped there. In Vail's fiscal second quarter, when visitation was down about 13%, lift revenue was down 2.9%. Ski school revenue fell about 9.3%. Dining fell about 6.9%. Retail and rental revenue fell about 6.8%. So the season pass did not create snow. It did not force a customer to buy lunch. It did not make them rent skis. It did not make them take a lesson. It did not guarantee that a disappointed skier would renew next year. The pass changed which part of the weather risk hit the business first. Instead of all the damage appearing immediately in access revenue, some of it moved into visitation-sensitive spending, operating conditions, customer satisfaction, and future renewal risk. That is a much more precise way to describe the pass model. It is not a weather hedge in the sense that weather stops mattering. It is a revenue stabilization mechanism. There is another advantage when one pass reaches many mountains. An independent ski area has one local weather outcome. A large portfolio has many. If conditions disappoint in one region, another mountain may have a better season. For the skier, access to more places makes the commitment easier to justify. For the operator, revenue becomes less dependent on one mountain's exact snowfall pattern. But this is not perfect diversification. Weather can be correlated across regions. A customer in New York cannot instantly substitute a Colorado mountain without travel costs. And a small Midwest ski area does not have the same economics as a large destination resort. The important point is narrower. A multi-resort pass can make advance commitment more valuable to both sides. That helps explain the revenue model. It does nothing to make the physical mountain cheap. A ski lift looks simple when you are sitting on one. The capital project behind it is not. And there is no honest universal sentence that says, a chairlift costs $10 million. Recent projects show why. Killington has described a new fixed-grip quad replacement for the 2026-2027 season at roughly $7.5 million. A different 6-seat high-speed chair installed there in 2025 was reported at roughly $12 million. Different capacity, different terminals, different foundations, different terrain, different access, different cost. And that is only installation or replacement capital. The annual business still has inspections, controls, grips, sheaves, electrical systems, mechanics, operators, parts, and maintenance. At Bridger, recent capital items included about $295,000 of mechanical upgrades to the Bridger lift, plus roughly $102,000 of other lift capital spending. Across the U.S. industry, the National Ski Areas Association's preliminary 2025-2026 data said reporting ski areas invested more than $569 million in capital expenditures, including 45 new lifts and 52 lift upgrades. So the lift is not a ticket printer. It is a long-lived asset that keeps demanding money after the ribbon-cutting ceremony. And even a perfect lift cannot move skiers over snow that does not exist. Snowmaking is one of the clearest examples of a ski resort paying money to reduce uncertainty. The system requires water, pumps, pipes, electrical infrastructure, snow guns, labor, and suitable weather. Snowmaking can reduce dependence on natural snowfall, but it still depends on sufficiently cold conditions. That means snowmaking reduces dependence on natural snowfall without eliminating dependence on weather. And the capital costs vary by project. Greek Peak announced a 4-year snowmaking modernization plan totaling about $2.5 million. Killington has allocated millions to snowmaking pipelines while also building out a fleet of more than 1,000 low-energy snow guns over recent years. The point is not that every resort should spend the same amount. The point is that reliable ski days can require a second infrastructure network hidden underneath the visible mountain. Peer-reviewed U.S. modeling also suggests climate exposure is highly regional. Higher elevation locations in some western regions may be more resilient than lower, warmer markets. But snowmaking itself still needs suitable conditions. For an owner, the climate question is therefore not simply, will it snow? It is, how much extra capital and operating cost will it take to preserve the same number of sellable ski days? Even after snow is on the ground, the product is not finished. Trails get scraped, bumped, blown, thawed, frozen, and cut apart by thousands of edges. Grooming machines go back out and reshape the surface. Bridger's recent capital list included a Prenoth Bison Snowcat at about $410,000. Then there is patrol, trail opening, first aid, rescue, signage, hazard mitigation, and the people required to operate the mountain safely. None of these produces a separate invoice that says $20 for tonight's grooming or $8 for patrol. They are embedded in the access product. That is why comparing a lift ticket only with the electricity required to spin the chair misses the business entirely. The customer is consuming a maintained operating system built on top of a mountain, and the most expensive recurring input in that operating system may not be the machinery. It may be people. Bridger's Fall 2025 materials say labor represents 64% of its expenditure budget. The previous season, it reported 578 employees. For the following budget, its base wage was planned to rise to $19 an hour. Think about the operating challenge behind those numbers. A resort needs lift operators, mechanics, snowmakers, groomers, patrol, guest services, rentals, food service, instructors, maintenance, cleaners, parking staff, and management. Some roles are year-round. Many are seasonal. Some require certifications or specialized mountain experience. For this representative model, we are not adding a separate employee housing or transportation cost because the research did not establish a clean Bridger figure. The labor constraint is already visible without inventing one. A lift may have room for more skiers, but if the resort cannot staff the lift, patrol the terrain, serve food, or maintain the equipment, the theoretical capacity does not matter. A skier can spend far more on a trip than the price of mountain access. Lessons, rentals, food, parking, lodging, retail, maybe a hotel, maybe a condo, but the mountain operator does not automatically receive all of that money. If an independent restaurant sits in town, its revenue does not belong in the ski resort's P&L. If the hotel is separately owned, a $2,000 lodging bill can generate zero hotel revenue for the mountain operator. At Bridger, food and beverage represented about 8% of the reported revenue mix in its Fall 2025 materials. That is meaningful, but it does not justify a claim that burgers are the secret profit center. And the Vail weak snow data shows why ancillary revenue creates both upside and exposure. When visits fell, ski school, dining, and retail and rental revenue all fell more sharply than lift revenue. So vertical integration can capture more of the customer's wallet. It also creates more businesses to staff, maintain, and expose to a weak season. More revenue streams do not automatically mean better returns. The owner needs contribution after the costs required to produce each one. Season passes are attractive partly because ski resorts have so many costs that exist whether the next skier arrives or not. Once the lift is running, patrol is on the mountain, and the trail is groomed, one additional skier may not require another lift or another snowcat that day. That can make incremental access attractive. Until the mountain fills. Then the economics reverse. Parking fills. Lift lines grow, trails become crowded, restaurants run out of seats, guest experience deteriorates. And suddenly, the next layer of demand may require millions of dollars of new infrastructure. This is why the marginal cost of another pass holder is not zero. At low utilization, another committed customer helps cover fixed costs. At high utilization, another committed customer can help trigger the need for another capital project. The pass model therefore solves one bottleneck and can create another. Demand becomes more predictable, capacity becomes more valuable, and more expensive. There is another tempting shortcut in ski economics. If some ski terrain is on public land, maybe the operator gets the mountain almost for free. That is not how the federal system works. For ski areas using national forest land, federal law sets a permit rent formula tied to adjusted gross revenue. Lift and pass revenue, ski school revenue, and qualifying ancillary revenue on federal land feed into that calculation, with the lift and pass portion adjusted for how much of the slope transport system is on national forest land. So the operator is not simply handed a mountain. It receives permission to operate under a regulated relationship, and part of the economic rent is linked to revenue. Bridger gives us a useful concrete picture because its base operations are on private property while ski terrain reaches onto national forest land. That means even the simple question, who owns the resort, can have several answers depending on whether we mean the land, lifts, buildings, parking, or surrounding real estate. Now we have enough pieces to open the books. We are going to build a transparent model from Bridger's published figures. This is not Bridger Bowl's audited forecast, and it is not a claim about what a private investor would actually receive. Bridger is a non-profit. We are using its operating data to understand the economics of a single mountain. Start with the budget anchor, 320,000 skier visits. Use the reported $71.31 of revenue per skier visit. Multiply those together, and modeled annual revenue is about $22.8 million. Now apply Bridger's published revenue mix. Roughly 46% from season passes gives us about $10.5 million. 31% from day tickets gives us about $7.1 million. 8% from food and beverage gives us about $1.8 million. Everything else in the model contributes roughly $3.4 million. Now the cost side. Bridger's fall materials state a target of 25% net income, with that surplus reinvested into operations and capital improvements. If we use that target only as a simplifying accounting proxy, our $22.8 million of revenue implies about $17.1 million of expenditures and about $5.7 million of accounting surplus. Then we encounter the capital problem. Bridger's spring materials separately described a $2.8 million capital spending plan for the next budget period. If we subtract that capital plan from our simplified surplus, we get roughly $2.9 million left as a post-capital proxy. That number is not free cash flow. We do not have enough depreciation, working capital, debt, and tax detail to make that claim. It is simply a bridge that forces us to acknowledge something many quick analyses ignore. The mountain can report an operating or accounting surplus and still need millions of dollars reinvested into physical assets. That difference is where a lot of apparent profitability disappears. A weather business should never be judged on one base case, so we will stress the model. And because the available disclosures do not give us a perfect fixed versus variable cost split, we will make one explicit modeling assumption. 80% of our simplified expense base stays fixed in the short run, and 20% moves with visits. That is our assumption, not a Bridger Bowl fact. For a weak snow case, let visits fall 15%. Roughly matching the scale of Vail's North American visitation decline in the 2025-2026 season. Hold season pass revenue fixed in the model because those customers have already committed. Let the non-pass revenue categories fall with visits. Let the variable portion of expense decline with visits too. Modeled revenue drops from about $22.8 million to about $21 million. The simplified operating surplus drops to roughly $4.4 million. After the same $2.8 million capital plan, the post-capital proxy falls to about $1.6 million. Now take a strong case. Instead of 320,000 visits, use Bridger's observed 363,944 visits from the prior season. That is about 13.7% above the model anchor. Again, keep pass revenue fixed for the scenario and scale non-pass revenue and the variable expense portion with visits. Modeled revenue rises to about $24.5 million. The simplified operating surplus rises to roughly $6.9 million. After the same capital plan, the post-capital proxy is about $4.1 million. So the weather swing does not need to bankrupt the resort to matter. It can cut the owner's economic cushion by more than half, even when the season pass portion of revenue holds steady. That is operating leverage. And it is why advance commitment is so valuable without being magical. We can turn the same model into one number that is easier to remember. Take the simplified annual expenditures implied by our base case and add the $2.8 million capital plan. Spread that total over 320,000 skier visits. The result is about $62.23 per skier visit. Again, this is not Bridger Bowl's audited break-even number. It is our break-even style threshold under the assumptions we just declared. Our modeled revenue per visit is $71.31. That leaves a cushion of only about $9 per visit before the things our simple model does not fully capture. This is the owner-level lesson. The visible ticket may be $99. The business can still live or die on a much smaller difference between realized revenue per visit and the full annual burden attached to serving that visit. At Vail's scale, the same principle gets larger, not simpler. For the 12 months ended April 30th, 2026, Vail reported total reported EBITDA of roughly $750 million. That sounds enormous. But the company also reported roughly $2.65 billion of net debt, and its capital programs run into hundreds of millions of dollars. For calendar 2026, Vail announced roughly $215 to $220 million of core capital investment and roughly $234 to $239 million of total capital investment. Its fiscal 2025 filing had separately identified roughly $124 to $128 million of maintenance capital expenditures inside that year's broader capital plan. These numbers do not mean we should mechanically subtract every capital dollar from EBITDA and call the remainder cash flow. Corporate accounting is more complicated than that, but they do prove the principle. A ski company's EBITDA is not the same thing as cash an owner can remove without consequences. The mountain depreciates physically, whether the income statement makes that obvious or not. Lifts age, snowmaking pipes age, snowcats wear out, buildings need work, parking and utilities need expansion. A responsible owner has to keep feeding capital back into the asset. Advance passes can make this year's access revenue more predictable. They cannot guarantee next year's pass sale. A warm winter can still produce fewer open trails, higher pressure on snowmaking, weaker ancillary spending, frustrated customers, and lower renewal demand. This is where climate risk becomes a financial question rather than an environmental essay. The relevant owner metric is not simply average temperature. It is how many sellable ski days the mountain can produce, how much capital is required to preserve those days, and how expensive each marginal day becomes. The answer will differ by elevation, latitude, water access, existing snowmaking infrastructure, and local weather patterns. So, the pass model does not remove the weather from the business. It changes the timing of the financial exposure. Some risk moves away from today's access decision. Some reappears in operating cost, ancillary revenue, guest experience, and tomorrow's renewal decision. We can finally return to the owner question. Is a ski resort a good business? There is no honest, universal answer. Our Bridger-style model shows why the business can work. A mountain with enough skier visits, disciplined costs, strong advance commitment, and a manageable capital program can generate a meaningful operating cushion even with a short season. But the same model also shows why the business can become fragile. If visits fall while most costs remain fixed, the cushion shrinks quickly. If infrastructure is old, a seemingly profitable year can hide the next lift replacement. If labor cannot be staffed, capacity becomes theoretical. If the resort captures little ancillary spending, much of the customer's wallet goes to other businesses. If snow reliability weakens, more capital may be required just to preserve the same product. And we have not invented a purchase price for our representative mountain, because without a credible transaction value, calculating an investor return would be fake precision. That matters. A mountain with a roughly $3 million post-capital model proxy could be attractive at one acquisition price and terrible at another. Add leverage, and the answer changes again. So the final verdict is conditional. A ski resort becomes economically attractive when enough customers commit early, enough visits arrive, enough of the visitor wallet belongs to the operator, fixed costs stay under control, and recurring capital does not consume the entire surplus. It becomes a trap when the owner pays too much for the asset, carries too much debt, underestimates reinvestment, and still depends on customers waiting until the last minute to see whether it snowed. Now go back to the mountain in August. There is still no snow, no groomed trail, No powder day, no guarantee that winter will cooperate, but money is already moving. That is the core of the modern ski business. The resort cannot control the weather, so it tries to control when the customer decides to pay. It discounts access in exchange for commitment. It takes a business that once depended much more heavily on the question, "Did it snow this week?" and moves part of the answer months earlier. Did we sell enough winter before winter arrived? The ski resort is not simply selling rides on a chairlift. It is selling access to an uncertain future season while using advance commitment to finance an extraordinarily expensive physical system before nature has delivered the product. And that is why the cheapest-looking product on the mountain, the season pass, can be the most important financial tool the owner has.